Getting your securities license doesn't make you good at selling securities, much less does it make you good as an advisor. I equate it to my kids getting their driver's license. Like, okay, passing the test and getting your license doesn't mean you become an expert driver.
What would be true about your vision to become a reality? What has to change today to get where you need to be?
Preparing is preparing for what the future result is going to be, not what the transaction is.
Welcome to the Total Succession Show. I'm your host, Tyson Ray, joined by Kim Kokenauer. We're glad you're here. Subscribe at totalsuccession.com/podcast and let each episode guide you closer to a confident, well-planned exit. Today's conversation just might be the nudge you need to start preparing for what's next.
Today, Tyson is sharing a story that's both personal and a cautionary tale for anybody listening. You advisors out there, this is about a practice he ended up acquiring and the advisor who built it, Mel. Mel was a man Tyson worked with, learned from, and ultimately had to pick up the pieces for. And this episode is about what happens when succession isn't planned and how you can avoid the same fate.
Bit of a painful story, but again, sometimes the best way to learn things is to learn what not to do. I think if I tried to look back at Mel's pitfalls, it was a lot of short-term thinking, a lot of reactive decisions, a lot of using the most recent past to try and guide clients into the future. And in the end, having to just walk away effectively.
Mm. Well, and truthfully, what happened to Mel didn't have to happen, but it did. And so there was a lot of broken trust and lost assets and hard lessons in that. And as Tyson said, sometimes that's how we learn the best. So Tyson, let's kind of get into this a little bit. Tell us about Mel. What kind of advisor was he?
Well, first of all, he was a very likable guy, and though all things equal didn't end well,
Mm.
he was still a likable guy. He was still just always had a smile on his face. But if I kind of had to kind of paint Mel, he was he was a salesman, the classic salesman. He always had the next idea to give you to buy. And quite frankly, if he would have gone into car sales or vacuum sales or any other type of sales, he would have probably been where he had a standardized product given to him. He would have probably been just fine. But I think his desire to always have something new to sell with clients that had limited resources really ultimately ended up working against him because he was selling things to buy other things, and you can only do that so much. I was once told, I just thought of this, once told, an investment is like a bar of soap. The more you handle it, the smaller it gets. Investments are like a bar of soap. The more you handle them, the smaller they get. AKA try and buy things and hold on to them and not change them very often is more likely going to give you success than trying to guess the next week's winning lotto numbers.
Well, and, Tyson, I think part of the bigger picture is kind of critical to this example is that it was the late 90s. And you were talking about how this is nearing the end of his career. So kind of tell us about that next.
Yeah, and I think there's a lot of advisors that had their careers that are still in the business, right? That was the 80s and 90s, or at very least a good chunk of the 90s and then the 2000s, and now they're ending their careers, but they have a practice that's kind of a hodgepodge of what that was like in the 90s, different from what it transitioned to over the last 20 plus years to more advisory and fee-based. Part of the reason for that, I feel like I'm aging myself here with my kids especially, is that the only way you could get information prior to the 2000s was the paper, or you called your broker. What is it actually trading at? What I can buy it at? Because we actually had the systems that were plugged into the trading platforms to have that. This is really before email. This is really before the internet started becoming in people's homes in mass. And so he loved to be able to get it. I've said it once. I've said it 100 times. Getting your securities license doesn't make you good at selling securities, much less does it make you good as an advisor. I equate it to my kids getting their driver's license. Like, okay, passing the test and getting your license doesn't mean you become an expert driver. But he was able to pass those exams, which some people aren't, and then was able to basically get the research sell list, and he would just call clients and get them interested in something and put them in it. And again, this was also back where it was all done based on commission. So everybody you're talking to kind of had their guard up to begin with. Um, but he was a charming guy. He loved his wife and his family. He was a good person, but he was going about the business in a way that was dying. I have another quote that really crystallizes what his career was. He was losing so slowly he thought he was winning.
Mm.
Um,
What
and it
does that
just
mean?
came undone. Um, it means because he was getting the commissions and getting the income that he needed to give him the lifestyle that he wanted, he thought everything was fine.
Mhm.
Um, And back in the late 1890s, I worked in the office with him. We were colleagues. I eventually went into this was in the broker-dealer world. I eventually went into branch management and where he started actually working technically for me, or more importantly, I was responsible for him.
Mm.
And I also was given management systems because when you're a colleague, it's like he'd tell me what his idea was. It's like, okay, yeah, whatever. But I didn't really know the client or know the situation or know what he was doing to the level you have when you have oversight. And now when I'm signing off on some of this, and I fundamentally don't agree with what it was happening, it was um, hard to watch. I think looking back on it, he was chasing trends. He was using last week's winning lotto numbers to sell today
Mm.
for a fee or a commission. And in the advisory business, for those of you who are listening to this, um, it's chasing stocks or chasing sectors. And so I remember in the 98, 99 transition of the market, he was going after great, great valuations in the healthcare sector. Well, it turned out because it was the climax of the tech bubble that everything sucked, but 20 some stocks that were all tech related. And
Mm.
so we bought these healthcare stocks and they went down. Of course, tech went up, and a year later, tech was the best performing sector that he could show a research report using hindsight to make forward-looking decisions. He then, in early 2000s, liquidated everybody out of the healthcare stocks that didn't do well and bought tech stocks that blew up over the next 6 to 12 months. And actually what did well that year was healthcare stocks.
Mm.
So if the adage is buy low, sell high, he was buying high and selling low. And it's you can't on a practice level across, and that's the thing, he was doing this for every client he could talk to that get him to say yes, so it
Mhm.
impregnated his entire practice, basically. He took about a $30 million book, which back then was pretty reasonable. In today's dollars, are probably like a $100 million book, and he cut it in a third, lost about $10 million in the healthcare stocks, bought the tech stocks, lost half of that, had about $12 million left to his practice when I finally basically sat down and said, "We need to talk about what your exit's gonna look like because these people are damaged, you did it, and I don't think you're the one to fix it."
Mm. Wow. Well, and one of the things that you kind of highlighted is that in the struggle in this is he was commission based. He made money every time he bought or sold things for his clients, and so his strategy or lack of strategy was reactive and driven by incentives for him, and it was chasing that past performance, and it wasn't led by the client's best interest. So when you sat down with him as the branch manager, kind of, how did you try to help in that instance?
I tried to show him what we were doing, which was, again, using more diversification. Um, we were still commission based back then. Fees really didn't start picking up until the technology caught up to everybody in their homes. So
Mm.
now, around 2000-ish was when all of a sudden, instead of paying an advisor 3 or $400 to do a trade, you could do it for $8, at
Mhm.
Ameritrade or pick the online company.
Mhm.
Um, and your love at AOL was your email that you get hot stock tips sent from God knows who. And so the beginning of 2000 was and the years that followed were, and really till about 2005 was the beginning of the industry had to shift on how it was shifting from we were your access point to buy. We were or sell. We were your advisor in the transaction to advisory. Um, I came on and I was in my early 20s when this all was happening, and add that to the conflict. But I started realizing that to compete against all of these quote unquote stockbrokers, uh, I needed to do something different to have the
Yeah.
client even want to come in and talk to this young whippersnapper. And I decided early on to become an expert in estate planning.
Mhm.
And what I figured out early on was the estate if you're going to help with the estate plan and partner with the attorney, you are going to see everything they have because everything they have is part of estate planning. Is the
Mhm.
non-qualified accounts titled correctly? Do the IRAs have beneficiaries? Do the CDs have, beneficiaries? How are those bank accounts? Like properties, business assets, everything. And what I quickly realized in the branch I was in and just the industry in general, the stockbroker was getting the stock money.
Mm.
And when I started realizing, wait, we can advise on all the money through the estate plan, we then could earn the right to just, at the very least, know where it all is and then work to help the client benefit from consolidating that or giving purpose to why do you own these things? And I tried to sit down and explain that this was, to see all and to know where all is and to add value separate from the transaction. I said, I think that's the future, and that's also an opportunity for you to reset. And the problem is, and even to this day, the problem is, it's hard to teach the old dog new tricks. They don't have the
Mhm.
energy, they don't have the flexibility, they don't maybe have the brain power to want to do it. They don't have the
Mhm.
interest. They haven't studied something in a long period of time, and so, hey, this has worked, so I'm going to keep doing it. And I think that's where there's a lot of advisors now looking to make some type of succession that have dabbled with fee-based business now, but they still have a big portion of their business that they're selling the annuity,
Mhm.
selling the UIT,
Mhm.
um, and in some cases still selling mutual funds or stocks where you're getting a commission up front, um, that they know they need to pivot.
Mhm.
They don't have the bandwidth, the power, the team, the history to pivot. Um, and my desire is to help those not become Mel.
Yeah. So Mel resigned. 30 million went down to about 12 million. And then it sounds like there was quite this mess to pick up between lawsuits of from upset clients, just a blow up in their portfolios, and that his business wasn't really a business. It was just this hodgepodge. And so you tried to kind of salvage what you could, but what did that process look like on the other side of him being out of the picture?
Yeah, so he got placed on special supervision. He kinda saw the writing on the wall. He wasn't dumb.
Mhm.
Um, and I was pretty transparent. It's like, "Hey, if you keep doing this, like, I'm gonna probably have to terminate you, not because necessarily I don't think this is salvageable. It's the firm the broker-dealer is gonna basically say to me, 'I'm going or you're going.'" And so what he had decided to do, I got married in 2021 in May, went on a honeymoon for all of a week, and came back to his resignation.
Mm.
And what was interesting about his resignation was he was not going back into the brokerage business. He found his new thing to sell, which is one of these vitamin pyramid schemes that he wanted actually me to sign up underneath him and offer those services to all of his clients
Oh,
and
wow.
my clients and the branch's clients, which is a total conflict, can't do it. Um, he then went and again, because all these people liked him, you liked him.
Mhm.
And because you liked him, that gave you the trust to accept the first or second or maybe third recommendation. But his problem was after the clients had experienced what they experienced in their investment that he
Mhm.
recommended, his thought that I'm gonna go back to my clients now and sell vitamins or sell this next thing that's the new
Mhm.
greatest thing that had nothing to do with stocks, turned them all off.
Yeah.
It also led to numerous lawsuits. It led to having to sit down with people that were damaged
Mm.
financially, some of which would never be able to recover,
Mm.
because the history shows, and now you know more than any advisor that's been in the business for 20 or 30 years, the tech bubble, the financial crisis, COVID, we've had all these opportunities for people to panic, and sometimes it's you, the advisor, that's listening to this that needs to panic. And without a predetermined strategy, without a team to help protect you from yourself, uh, you can, if clients do any one of those wrong, they never recover from it.
Mhm.
Um, It was a mess.
Yeah, it sounds like it was a mess. One of the things I think we kind of need to step back a little bit in the painfulness of Mel's story is that it can serve as a powerful wake up call for the advisor listening. If you're listening to this, this can be a wake up call for you. If some of this is resonating, if you've been panicking, if you've not been making predetermined investment decisions future forward, in your thoughts, this is a great opportunity for you to kind of stop and keep yourself from continuing to build on these same mistakes. So, Tyson, when we look back over Mel's story, it's clear that every misstep falls into the 5 key areas you talk about in the space framework because even when he left, he didn't have a team, nothing was documented. He didn't think about what it would be like if he wasn't there. So, let's kind of get into the space framework of see, prepare, act, commit, or exit. And let's start with C. What didn't Mel see?
So first of all, Mel came into the business as his second or third career, which is how people were hired back then. Because of, if you're in your second or third career and he was probably in his um, late 50s when he got in the business, he was probably in the beginning of his 60s excuse me, he was probably in his mid 50s when he got into the business. And then when I showed up, he was just turning 60. And because he was so focused on today and what I have to sell today and the excitement behind that, he didn't see this. He got in the business. Most people get in this business as in their second or third career because, as one person that tried to get me to hire them, he literally said, "In my other careers, I didn't make enough money to retire, and so I'm getting in this business to make enough money to retire." Well, if you have enough time and you do the right thing, you can build quite a valuable business. That's why he got into the business, but he
Mm,
never built anything that had any lasting value, and he got so focused, and some advisors get so focused on making as much money as they can in selling products of a commission or annuities and these other things that are out there, because if you can be paid for the same investment, an investment that is an advisory fee of 1% takes 5 years in some cases, the growth, take the growth out of it, as an investment that pays you 5% upfront.
correct.
And so his thought is, I'll take it upfront. Well, okay, but then the business is trapped with all these assets. There's nothing to sell in the end, and that's where the real value is. So he didn't see his future was coming quickly in the form of wanting to retire, wanting to have a quality of life, to be out with his wife who he loved and his kids. And then he started having grandkids and he wanted to be with them again. Family guy, great guy. I still to this day, I could sit down and have a cup of coffee with him and he's fun to talk to, is great. But he didn't see that he was sacrificing doing the right thing for the future of the value of the business in
Mhm,
exchange for this commission up front or this being paid up front. He didn't see the benefit of, hey, you don't want to do some of these things, estate planning, some of this other stuff that could really help your client and help your practice. And should we maybe consider bringing on a junior partner underneath you who has the energy or has the desire or still remembers how to study and learn new things to apply those things? He just missed the bigger picture. Um, he missed that he was, um, penny wise and pound foolish. He was basically
mm.
focused on what I can get today, and it was literally at the expense of tomorrow and the rest of his career, that he ended up literally walking out the door and
Mm.
trying to start over.
That's a hard stage of life to have to start over, and that focus on instant gratification and that immediate sale need really kind of hurt him at the end. So let's talk about prepare. Prepare is where I think and feel Mel dropped the ball.
Yeah, if you're looking if you're within 5 to 10 years of wanting to make an exit, of wanting to make a succession, um, there's some there's some things you have to prepare for. One of them is, his investment strategy was what came to him. Okay, therefore, if you're not there and you had no team members, like, how do you continue that investment strategy? It's in your head.
Yeah.
One of the things to prepare for, and one of the things we believe in, and one of the things we wrote in the other book with Total Relationship, and one of the things we wrote in the first book I wrote, Your World Impact as a Financial Advisor, is having a predetermined investment strategy. A
Mhm.
predetermined investment strategy is based on what we think is best going forward, so it doesn't use past performance as much as it uses capital market assumptions, which is in every financial planning software that uses Monte Carlo systems. They're using a capital market assumption of what future rates of return could be and the randomness of those returns to create the percentage probability analysis of success. Therefore, one can basically create a predetermined investment strategy of what a retirement portfolio should be in, what a short-term portfolio should be in, and use that what I have found is having a predetermined investment strategy protected the client, protected me, protected the team we have from getting caught up in the hot trend.
Mhm.
He didn't prepare himself for what if I'm wrong?
Mm.
If you're putting a hot idea or a concentrated position in every client's account, before you do that, you might wanna ask yourself, "What if that doesn't work?" More importantly, you might wanna tell the client, "Hey, if this doesn't work, this is the plan." Preparing is preparing for what the future result is going to be, not what the transaction is. I think the other thing he didn't prepare for, again, was the fact that, he wanted to be done in 5 years and never thought in terms of, "What do I need to do for the client and for the value of this practice? Maybe I need to start sacrificing, taking all this income up front," which effectively, especially in the annuity platform that he used, uh, locks assets up. And ironically, this Mel is a 99, for me, it was a 98, 99, 2000, 2001. He was done, 4 years experience. But in 2021, we had another associate that that we were working with that it was basically just the same hodgepodge of investments. It was the same, annuity focused. As soon as the annuity was out of surrender, let's get him another annuity. It was the same, make as much money as I can now.
Mhm.
Um, and the same idea, 61, had only a few years left, and I think there are some advisors out there that's because that's how they did it, so they just kept
Mhm.
doing it. The clients became to expect the rollover, this is out of surrender, now we're gonna go to this next newer one, not realizing that, uh, that may not have been the best long-term strategy for their
Mhm.
retirement assets or the assets that got bought into those things. He never created the space to even begin to see or prepare or act or commit to anything.
Mhm. That's challenging, especially when you're there having to pick up all of that. So let's talk about ACT. Mel was very reactive, strictly reactive, not strategic. And I think that sometimes because the market is so volatile or the urgent crowds off the important, the advisors often are stuck in this cyclical reactive behavior. So let's talk a little bit about why Mel was that way and some of your thoughts on that.
When it came to acting, in the concept of the SPACE acronym, it's you're gonna see what is your future? What is your big dream? What are you working towards? What do your loved one want for you? What do you wanna do when you're no longer working? That's all part of seeing, and then it's preparing to do whatever is necessary to accomplish that, and then acting on those principles, and all because he never took the time or created the space or was thinking in any mindset of these terms, all he kept acting on was the same pattern that he did the day before and the day before and the day before.
Mhm.
And effectively, if you're trying to build a bigger future and you're trying to build a business that has value in a succession, you can't do that acting in the rearview mirror, acting off of past performance, acting off of past behavior because it traps you from the future you're trying to build.
So let's move on to commit. Where do you think this really kind of landed with Mel? Because kind of when the ball was dropped or everything kind of blew up, what was Mel's response? Was he committed to fixing the problems? Was that kind of just was he able to move forward? How did you help him do that? Or just what happened? Or did he have the choice to?
In the end, he didn't have the choice to, and the reality was he wasn't committed to making the changes necessary to solve the problem, and in the end, after doing it wrong severely to almost every client within a 2 or 3 year period of time, um, in the end, I think the reason he walked away, and in the end, I think the associate in 2021, decided to make an exit was because he didn't wanna face the clients and basically explain, "Hey, we need to do something different." Or
Mm,
own the fact that this didn't work. I
Mm.
think it was so bad, I don't think he wanted to face the clients and go back to them and basically with, again, $30 million book that became $12 million in the course of about 24 months, own his recommendations or be responsible
Yeah.
to fixing it.
Sure.
And so therefore, um, if you're not willing to create the space to see, to prepare, to take action, to commit to other things, you're going to have an exit that you have no control over. You're going to have an exit
Mm.
that is determined for you, not one you determined.
Yep.
And Mel is early in my career an example of why I'm so passionate about creating these podcasts, telling these stories, and trying to help advisors um, create the space to understand what a succession can look like and what are you working towards, not what are you doing today.
Mhm. Yeah, well, and you kinda jumped right into that exit, that it was pretty much a disaster, and it left you with kind of a mess of lawsuits and client complaints, and it was clearly the value of that practice was wiped out.
Yeah, hence he walked away. There was no one was going to buy that practice. It was damaged. And in
Yeah.
fact, the associate I brought in to basically help take over that practice, I said, all of these people have been hurt, all of them have been damaged, and
Mm.
what they need is someone to come in and fix it.
Now that we've kind of walked through Mel's story and kind of how it fell apart, what are some of the key lessons here? To the advisor listening, what should they be thinking about right now?
Well, I think if you're listening to this, you're one of a few different advisors, right? You're listening to this and you're saying, thank God I'm not Mel.
Mm.
And yet there are still some things you may be needing to do in creating the space and figuring out what your bigger future is and what your succession is going to look like. Or you're realizing that you have a little Mel in you.
Mm.
Um, and you have to ask yourself, if you're listening to this, do you want to fix it? Or do you want to create a succession that fixes it for you?
Mm.
Or you're Mel that's listening to this and you're not going to fix it. And you're going to be disappointed, I would say, in what your practice is going to end up being worth when you leave it or it's taken from you or you abandon it.
So when you kind of look back, it's a reminder that the practice shouldn't really be built entirely on one person and their decisions. It's really a business. And when the person leaves, or there's one person making all of those choices, and there's not any checks and balances in place, everything can really collapse. Um, so let's shift from some reflection on this, looking back into some of the practical. For those listening, what can they actually do today to start preparing? If they see a little bit of themselves in Mel, they work with a Mel, they work for a Mel. Like, what can they do to start preparing and taking that SPACE acronym for themselves in forward action?
I think they first need to realize, and I don't know if enough of advisors acknowledge this, and I think clients are thinking about it, maybe talking to you about it, maybe not. But the question you need to ask yourself is, are you going to retire in your client's retirement?
Well,
Because they're entrusting you in some cases with their life savings or entrusting you with some of their wealth that they're going to need for their retirement. And are you going to be around and are you going to be accountable for the decisions you make today, 10 or 15 years from now, when they're going to find out, did your recommendations work?
mm,
And use the fact that your decisions today are going to be judged for the rest of their life, the client's life. Um, and if your accountability to them is not for the rest of their lives, what are you doing to fix that?
mm,
Whether that's one, creating a vision or creating a mindset around the integrity and the wisdom of setting the client up for success. So when you bump into your friends, your family, these people become clients, become like family members. You really like these people. They really like you. Well, great. What's it going to be like in the town that you're in the church that you go to the sporting events you're involved in, to the golf course, to the network that these people came from, when you're bumping into them in their retirement, you're now retired. And how did you do? Because you're gonna feel it and they're gonna feel it.
Mm.
And that almost becomes the accountability to which you should then be managing your practice, managing your investment advice, having the vision, building the systems and documenting who these people are so someone else can take over and know that this person's related to this person. These two people are best friends. These are the client's kids, brothers, sisters, uncles. Like, how is the practice related to each other? Where did the wealth come from? What's the wealth story that you know that when someone steps into your shoes, they know, so they know why these positions are there, how the clients react to risk, how the clients decided on what the plan was. Um, it's realizing that you need to commit to maybe doing some things differently if you haven't done these things yet, or you need to maybe shift your thinking um, to be able to determine what your exit is, so it's not determined for you.
So Mel's story might feel extreme to some listeners, but the truth is, there's a lot of practices out there that look very similar to this, and they're kind of running up against the same issue. And so, if you're listening and wondering what would happen if you weren't in your firm tomorrow and you're seeing some of Mel's story in yours, you need to take action now. And so, Tyson covered Mel's story in the space framework and provided some powerful lessons, but it's kind of time for you to bring it all together. Succession in your practice is not optional. You will leave your practice one way or another by choice or circumstance. And so the challenge for you is to sit down with a blank sheet of paper, write out your personal vision for what your life after your business looks like, and also evaluate your business in reflection to the story of Mel's life and business to see where you might have some parallels and where some of those areas of priorities you need to focus on first. What would be true about your vision to become a reality? What has to change today to get where you need to be? Because if you're not starting from that place, you're not going to get any further, and you have the potential to repeat some of these same mistakes. And also, work with people in your corner that can help you identify some of those areas if you are blind to them. If there's an advisor out there whose practice reflects the values that you're looking towards in your own, send an email, get a cup of coffee with them, start working on building that network of people that you can align your practice with so that you're not making these decisions out on an island and falling victim to some of the things that happen in Mel's story. So, Tyson, do you have any final thoughts for the listeners?
First and foremost is the whole point of your career is to avoid future regret. So in your retirement, in your late 60s and 70s, when you're around your family and your friends that are now clients that have been transitioned to somebody else, that you don't have any regrets. That you don't regret your decision, that you can leave your
Mm.
clients, think of it this way, y your opportunity is to leave your clients in better off when you walk away if you're not willing to fix maybe the practice that's been built over the years by just ways of doing things. Um, and if you really are honest with yourself and you haven't built the practice right, you can start today by fixing that.
Mm.
You can create a succession that fixes that. And the reason we're doing this total succession and the reason I have an advisory firm that's acquired other retiring advisors, the reason we acquired another Mel-like advisor in 2021, our purpose is to protect clients from some of the malpractice and some of the conflicts of interest that are in the financial services industry by allowing Mel-like advisors to basically walk away from their practice, receive compensation, whatever that is, for the value of their practice based on how the practice is built, and then giving the clients a completely different experience. So that way, I know for the few Mel clients that are still alive and still with us, if they ran into Mel, they're thankful that we took it over.
Mm. Yeah.
And will your clients be thankful for what you decide in the end, who they end up with? Who's advising them? And how did that transition go?
Well, and Tyson, I think it's a good message to be heard that there is hope in that. There is a solution for that advisor out there. That there are firms that will help step in that gap and help make the best decision for the client's future and put their best interests first.
Yeah. That's what total succession's about.
Yes, it is. Happy to be here to help get the message out. So thanks everyone for listening. We'll be back soon with more conversations like this.
These conversations are designed to support your next move, however close or far it may be. Tap subscribe and let each episode guide you closer to a confident, well-planned exit. I've wrestled with these things myself, and that's exactly why I created something to help you do it with less stress and more direction. My book, Total Succession, is now available on Amazon. Inside, I break the process down into 5 clear steps to help you exit on your terms with confidence, full compensation, and your client's best interests at heart. You can also visit totalsuccession.com/podcast to download a free starter guide that walks you through my SPACE framework: see, prepare, act, commit, exit. Remember, you only exit your business once. Create the space to do it well. Thanks for listening. Until next time.